The financial world is holding its breath for a September rate cut, but the real mystery and the real risk begins the very next day. While the initial market reaction to the Federal Reserve signals has been euphoric, the path forward for interest rates is shrouded in deep uncertainty, and the long-term consequences for the economy are anything but clear. Let's rewind. On Friday, August 22, 2025, a wave of optimism swept across trading floors like the New York Stock Exchange. The catalyst? Federal Reserve Chair Jerome Powell's speech at the high-profile Jackson Hole Symposium. In the carefully coded language of central banking, known as Fed speak, Powell indicated that economic conditions may warrant adjusting our policy stance. To Wall Street, this was a clear signal that interest rate cuts are on the horizon. The immediate reaction was dramatic. Stock prices surged and Treasury yields, which move opposite to price, fell sharply as investors positioned themselves for cheaper money. The excitement centered on the next meeting of the Fed's Policy Committee on September 17th, where a 0.25 percentage point cut from the current rate of 4.3% is now seen as a near certainty. In fact, futures market data from the CME Group's FedWatch tool shows traders are pricing in an 82% probability of this happening, a significant increase from just a month ago. But here's where it gets controversial. The celebration was short-lived. By Monday, the initial cheer had turned to sober caution. Stocks mostly retreated, and shorter-term Treasury yields crept higher as a reality check set in. The big question is no longer if the Fed will cut in September, but what happens after that. The market's confidence evaporates when looking further out. The probability of a second consecutive cut in October is a shaky 42%. While a second cut is fully expected by December, the chance of 3 total cuts this year sits at a mere 33%. This reveals a massive divergence of opinion on the Fed's long-term strategy. So, why the hesitation? The debate hinges on a fundamental clash of viewpoints. On one side, skeptics like Kaysen Granette, Chief Investment Officer at BNY, advocate for a slower, more measured pace. They argue the Fed has merely moved the door ajar for September, not kicked it wide open for a long series of cuts. Their caution is rooted in 2 persistent worries: inflation, potentially reignited by new tariffs, and an economy that, while showing some cracks in the labor market, remains surprisingly resilient. This leads to a provocative and hotly debated question posed by Lisa Shallett, Chief Investment Officer at Morgan Stanley. What problem exactly is the Fed rushing to solve? In a client note, she expressed deep skepticism, assigning only a 50% chance to a September cut. Her firm points to uncertain inflation data and, quite controversially, the intense political pressure being applied by President Donald Trump and White House officials demanding lower rates. This raises serious concerns about the Fed's cherished independence. Shallett also throws cold water on the idea that rate cuts will automatically propel stocks higher, noting that outside of a recession, easing cycles tend to be shallow and may have less impact than in the past. And this is the part most people miss. The very act of cutting rates could backfire. Market veteran Ed Yardeni of Yardeni Research warns we might be on the verge of repeating a surprising pattern from 2024. Last year, the Fed cut rates, but longer-term bond yields and mortgage rates actually increased. Why? Because the market interpreted the Fed's move as a sign of worry, sparking fears of stronger growth and inflation down the road. If this happens again, it would completely undermine the goals of the rate cut, making it more expensive for the government to finance its debt and doing nothing to help the housing market with lower mortgage rates. Yardeni presents a fascinating counterpoint, however. Even if the Fed is making a policy mistake by cutting, he believes the stock market's bull run will continue, powered primarily by strong corporate earnings rather than just cheap money. He maintains a strikingly optimistic forecast, seeing the S&P 500 climbing to 6,600 by year's end and potentially reaching 7,500 in 2026. This leaves us with a tremendous dilemma. The market is betting on a single cut, but is deeply divided on everything that follows. Will the Fed bow to political pressure and risk its credibility? Or will it hold firm and move slowly? Could their attempt to stimulate the economy actually trigger the very inflation and higher borrowing costs they hope to avoid? What do you think? Is the market's optimism for September justified, or is it setting itself up for a major disappointment? Do you believe the Fed can maintain its independence amidst intense political scrutiny? Share your thoughts and disagreements in the comments below. We want to hear your take on this high-stakes debate.